This is John Agee, and you are watching John Agee World, where we do not repeat headlines, we break down the real numbers that most people never take the time to study carefully. Before we go any further, I want you to go straight to the comment section and type two simple words, currency archive, because that tells me you are here for real data and not the watered-down version that gets pushed during prime time. When you type currency archive, you are saying that you care about facts, charts, vault levels, delivery pressure, and the deeper forces moving markets behind the scenes. Now let us talk about what just happened, because the crash everyone felt was not small, it was fast, sharp, and powerful enough to shake out weak hands in less than 2 days. Silver dropped from $96.40 to $78.06 in under 48 hours, which means the market erased 19% of its value almost overnight, and that kind of drop creates panic whether people admit it or not. At the exact same time, the Dow fell 1,100 points in that session. The dollar jumped to a 6-week high, and the ISM prices paid index printed 70.5, which was the highest reading since June 2022. That inflation number crushed hopes for rate cuts, and once traders realized rates might stay high longer than expected, margin calls started hitting leveraged silver positions hard. Every technical level that traders were watching broke one after another, including the 200-period moving average sitting at $87.69, and once that level failed, forced selling accelerated. But here is what matters most. By Wednesday, March 4th, silver had already bounced back to $85.64, and JM Bullion was asking $86.77, proving that buyers stepped in quickly. The bounce was not fake, and it was not weak, but the deeper question is whether anything in the fundamental structure actually changed during that violent drop. The simple answer is no. Not one of the core supply issues was solved, not one vault magically refilled, and not one structural pressure disappeared. So instead of guessing where silver might go next, let us walk step by step through the physical market data that gets updated daily but rarely gets real attention. Start with registered COMEX silver inventory, because that number tells you how much silver is actually available for delivery against futures contracts. On February 9th, registered silver stood at 102,256,630 ounces, which was already lower than past years but still offered a visible cushion. By March 3rd, that number had fallen to 87,985,490 ounces, meaning over 14 million ounces left the registered category in just 22 trading days. That works out to nearly 650,000 ounces per day, draining from the only pool of silver that can legally settle a futures delivery obligation. When registered inventory drops that fast, it does not mean paperwork shifted around, it means physical metal moved. Now look at total COMEX vault holdings, which include both registered and eligible silver combined. On March 3rd, total vault silver stood at 355,173,810 ounces, but back in October 2025, that total was 532 million ounces. That is a 33% decline in just 5 months. And no amount of chart analysis can ignore that kind of physical drawdown. Metal is not being reshuffled inside the system. It is leaving the vaults entirely, and that is the difference between cosmetic changes and real tightening. March deliveries add even more pressure, because over 52 million ounces have already been delivered this month alone. That delivery volume represents 10,526 contracts that stood for physical settlement on first notice day, which fell on February 27th. By March 3rd, more than 5,600 of those contracts had already been fulfilled, with hundreds delivered in a single day. This pace is far above what modern COMEX history has recorded before, and that matters because high delivery rates drain inventory fast. While all of this was happening in March, the May contract was not shrinking, it was growing. On February 27th, May open interest stood at 78,864 contracts, which equals 394,300,000 ounces of silver on paper. By March 3rd, that open interest increased to 80,274 contracts, pushing total paper claims to 401,400,000 ounces. So while physical metal was draining and record deliveries were happening, paper exposure expanded instead of cooling down. Let that number sink in for a moment, because 401 million ounces of open interest exist against only about 88 million ounces of registered silver. May 1st notice day is April 30th, 2026, which is 57 days away. And between now and that date, every contract holder must decide what to do. They can roll their position to July, they can close it entirely, or they can stand for physical delivery. Back in January 2026, around 62% of contracts that entered the delivery window ended up demanding real metal. February saw a lower percentage because prices spiked and cash settlements increased, but the core pressure that fueled January has not gone away. Registered inventory is lower now, the physical market is tighter now, and lease rates are higher now, If just 10% of May contracts stand for delivery, that equals 40,100,000 ounces, which is nearly half of registered supply. If 15% stand, that jumps to over 60 million ounces, eating up roughly 2/3 of what is available. If 20% stand, more than 80 million ounces would be claimed, which is about 91% of registered inventory. And if 25% stand, the entire registered pool would be spoken for, with contracts still left waiting. These are not extreme predictions pulled out of thin air, because January's cycle approached much higher participation. If May follows even a moderate historical pattern, the exchange could face serious stress. At that point, options become limited, including converting eligible metal, delaying deliveries, or offering large cash premiums to settle. None of those outcomes are normal in a stable commodity market, and each one would likely trigger a strong price reaction. Now shift your focus to China, because China plays a huge role in this story. According to data shared on March 4th by analyst James Henry Anderson, combined SHFE and SGE vault stocks have fallen to 752 tons, or about 24,200,000 ounces. He described that level as the lowest in 10 years, and that statement alone should get attention. China consumes roughly 230 million ounces of silver per year through solar panels, electric vehicles, and electronics manufacturing. When you compare 24 million ounces of vault stock to 230 million ounces of yearly use, you are looking at roughly 5 weeks of supply. That is not a comfortable buffer. It is razor thin. Bloomberg had already confirmed in November 2025 that Chinese silver stocks hit a decade low, and ING reported similar findings at the time. The key point is that the drawdown did not stop in late 2025. It continued into early March 2026. Shanghai silver traded at a 17% premium over Western spot prices in early March, and price gaps like that show stress. When the same metal trades at different prices in connected markets, it means the normal flow of supply is restricted. China added export controls in January 2026 that require silver exporters to hold at least 80 tons of yearly production capacity. That rule removed many smaller producers from the export market overnight. At the same time, SHFE reduced daily position limits by 73%, cutting them from 3,000 lots to 800 per session. Several Chinese silver and gold funds also paused new subscriptions starting January 28. These actions are not random adjustments, they are policy decisions. China appears to be treating silver as a strategic material, and when governments start protecting supply, global markets feel it. China produces about 17% of global silver mine output and exports between 4,000 and 5,000 tons annually. If exports slow or tighten, Western buyers lose a key source of supply they have relied on for years. And that brings us back to the central issue, which is that physical silver does not appear to be loosening even after a sharp 19% price drop. The crash changed the paper price quickly, but it did not refill vaults, ease lease rates, or reduce structural deficits. That disconnect between paper pricing and physical reality is the core theme we are tracking here on John AG World. Now that we have walked through the inventory numbers and delivery pressure, we need to dig into the signals that separate surface-level analysis from true market understanding, because this is where the story becomes impossible to ignore. One of the most important signals right now is the silver lease rate, and most people skip over it because it sounds technical, even though it directly reflects how tight physical supply really is. On March 3rd, the one-year silver swap rate stood at negative 2.973%, and that number is not random noise. It is a warning sign flashing in bright red for anyone paying attention. In a normal and balanced commodity market, forward prices trade above spot prices because of what is called cost of carry, which includes interest rates and storage costs. Right now, the risk-free rate sits around 4.25%, and storage for silver runs about 0.27% per year, meaning forward silver should naturally trade several percent above spot. Instead, the market is pricing forward silver below where financial math says it should be, creating a deep negative swap rate that is almost unheard of in modern silver history. When you adjust for the risk-free rate, that negative 2.973% swap translates into roughly a 7% deviation from fair value. That means the market is willing to lock in future delivery of physical silver at a discount today, because participants fear they may not be able to source the metal easily later. Think about that for a moment. Because investors are effectively accepting unfavorable math just to guarantee access to physical silver 12 months from now. Markets do not behave like that unless there is genuine concern about supply. This is not a rounding error or a short-term glitch. It is the financial system pricing in scarcity risk. Now let us look at the one-month lease rate, which recently hovered near 3%, a level that is more than 30 times the 5-year average between 2019 and 2024. For years, the average lease rate was slightly negative, around negative 0.09%, which reflected a market with comfortable supply. Today, we are seeing lease rates multiple times higher than historical norms, and elevated lease rates mean borrowers are paying up to secure silver. When someone borrows silver, they usually need it for delivery, hedging, or industrial use, so a rising lease rate signals real demand pressure. Some people noticed that lease rates fell from their late January peak, but that decline needs context. In late January, silver hit its all-time high of $121.67, and lease rates briefly spiked to around 7% or even 8%. Then on January 29th, margin requirements were raised from 15% to 18%, forcing leveraged traders to liquidate. The next day, silver crashed by 33%, falling from $121 to near $80 before stabilizing. That crash scared out speculative traders, reducing short-term borrowing demand, which caused lease rates to fall. But the drop in lease rates was not due to new supply entering the market. It was due to shaken confidence and forced selling. A lease rate that falls because traders got wiped out is not the same as a lease rate falling because supply improved. The physical metal did not suddenly become easier to find. The urgency simply paused for a moment. Now look at the forward curve, because this is another area where the market is sending a loud message. May futures were recently trading at $83.47, while July futures sat around $84.08. Creating a spread that should normally be positive in a healthy market. Instead, when adjusted for carry costs, the market shows backwardation, meaning near-term contracts trade at a premium compared to future months. Backwardation tells you that buyers want metal now rather than later, and they are willing to pay extra for immediate delivery. In stable markets with no supply stress, futures prices usually slope upward because sellers demand compensation for storage and time. When that curve flips downward, it reflects urgency, and silver has been stuck in backwardation for months. Even during the violent price crash from $96 to $78, backwardation did not disappear. That fact alone proves the crash was driven by paper selling rather than physical relief. Physical buyers did not step back, and physical supply did not improve. The market structure stayed tight even while prices dropped fast. Now let us bring ETFs into the discussion, because retail investors play a key role in the silver ecosystem. Between December 2025 and early March, total silver ETF holdings dropped from about 870 million ounces to around 828 million ounces. That is a 42 million ounce reduction, which should have eased pressure if the market were balanced. Retail investors sold roughly 15 million ounces through SLV redemptions since February 9th alone. Normally, that kind of selling would cool lease rates, ease backwardation, and rebuild registered inventories. Instead, none of those stress signals normalized. COMEX registered inventory continued falling by over 14 million ounces during that same time period. Lease rates stayed elevated, swap rates remained deeply negative, and backwardation persisted. This suggests that institutional players absorbed the metal retail investors sold. Banks like Bank of America and Citigroup reportedly took delivery through COMEX, effectively transferring silver from ETF vaults into bank balance sheets. Retail sold paper exposure, but physical supply did not flood the broader market. The total pool of freely available silver actually became more concentrated. Now retail buying is returning, as SLV reported $1,750 million in net inflows over the last 30 days as of March 3rd. When investors buy SLV shares, authorized participants must deposit physical silver with the trust. They cannot create new shares without sourcing real metal. If sourcing metal is already difficult, that inflow increases pressure. SLV recently traded at a 4.86% discount to net asset value, which is unusual in normal conditions. Authorized participants typically arbitrage such gaps quickly, buying silver and creating shares to close the discount. When the discount persists, it may mean sourcing physical silver in size has become expensive or difficult. Either explanation points back to tight physical supply. Now let us zoom out and look at cumulative deficits. The Silver Institute projects a 67 million ounce deficit for 2026, marking the sixth consecutive annual deficit. Since 2021, cumulative deficits total around 820 million ounces. Global mine production runs roughly 820 million ounces per year. In other words, the market has consumed the equivalent of an entire year of global mine output from above-ground stocks over the last 5 years. Above-ground stocks are the buffer that prevents sudden shortages from triggering massive price spikes. When that buffer shrinks year after year, volatility increases. Solar energy is a major driver of this demand. In 2025, photovoltaic applications used around 230 million ounces of silver. Each solar panel requires roughly 20 grams of silver in its conductive layers. Every gigawatt of solar capacity added represents about 1 million ounces of silver demand. With energy shocks pushing countries toward domestic renewable power, solar deployment is accelerating. European natural gas prices spiked sharply during recent geopolitical tensions, strengthening political support for solar expansion. The European Union already mandated solar integration for new buildings starting in 2026, and that policy now carries even stronger backing. Electric vehicles, AI data centers, and advanced electronics also rely heavily on silver for conductivity and reliability. These uses are not speculative trends. They are embedded in industrial design and engineering standards. Unlike investment demand, industrial demand cannot instantly disappear when prices rise. Manufacturers cannot easily swap out silver without sacrificing performance. That means price must rise significantly before demand begins adjusting. Mine supply, on the other hand, cannot respond quickly. New projects often take 7 to 15 years from discovery to production. Scrap recycling can increase when prices climb, but scrap supply is limited in the short run. This mismatch between rigid supply and strong demand creates structural tension. Now consider the COMEX stress index reading of 79 out of a maximum of 88. The previous record was 64 back in September 2025. Today's reading is about 23% higher than that prior record. What does it mean when stress levels are at all-time highs while prices sit nearly 29% below their peak? It means the paper market and physical market are diverging sharply. Paper prices respond instantly to margin changes, dollar strength, and rate expectations. Physical markets respond slowly to actual flows of metal. Eventually, those two realities must reconnect. Historically, in commodity markets, resolution usually comes through price. When shortages persist, prices rise until supply increases or demand becomes too expensive. In silver's case, industrial demand is locked in by engineering needs. Solar manufacturers cannot replace silver with aluminum without losing efficiency. EV producers cannot downgrade conductive materials without harming performance. That leaves price as the adjustment mechanism. The $78.06 low on March 3rd was not driven by new supply. It was driven by forced liquidation. The physical side of the market barely changed during that drop. Registered inventory continued falling, lease rates remained elevated, and Chinese vault levels kept shrinking. As of March 4th, silver sits near $85. May 1st notice day arrives on April 30th. Roughly 401 million ounces of open interest exist against only 88 million ounces of registered supply. Retail buying is returning, Chinese inventories remain near decade lows, and structural deficits persist. Every major data point is pointing in the same direction. The paper price can swing violently in the short term, but the physical market tells a slower, deeper story. And right now, that story suggests that the disconnect cannot last forever. Now let us connect every piece of this puzzle, because when you step back and look at the full picture, the message becomes much clearer than any single chart or headline could ever show. Right now, we have a paper market that can drop 19% in less than 48 hours, and a physical market that barely reacts to that drop in terms of actual supply relief. We have 401,400,000 ounces of open interest sitting in the May contract, while only about 88 million ounces of registered silver are available for delivery. We have Chinese vault stocks near 24,200,000 ounces, which equals roughly 5 weeks of industrial consumption for a country that runs one of the largest manufacturing systems on Earth. We have cumulative global silver deficits totaling about 820 million ounces since 2021, which equals an entire year of global mine production. We have lease rates running many times above their long-term average, and a one-year swap rate sitting at negative 2.973%, signaling fear about future supply access. When all of those signals align at the same time, that is not random coincidence, that is structural tension building inside the system. Now here's the key question everyone should be asking. What event forces the paper market to respect the physical reality? Because until that trigger happens, futures prices can move on dollar strength, rate expectations, inflation headlines, or margin adjustments. We already saw how quickly leverage can unwind when margin requirements were raised from 15% to 18% back in late January. That change crushed leveraged long positions and sent silver from $121.67 down toward $80 almost overnight. But here is what did not change during that collapse. The number of ounces inside vaults did not suddenly jump higher. Physical supply did not increase by a single meaningful amount during that crash. The price moved because traders were forced to sell paper contracts, not because warehouses were suddenly overflowing with metal. That distinction is critical, because it shows how disconnected short-term price swings can be from long-term supply stress. Now focus on April 30th, which is May 1st notice day, because that date acts like a pressure valve. Between now and that date, every holder of a May contract must decide whether to roll forward, close out, or demand delivery. If delivery demand comes in even at 15% of open interest, that represents more than 60 million ounces. If it reaches 20%, that pushes above 80 million ounces, which is nearly the entire registered category. And if it climbs to 25%, you have a situation where claims exceed the immediately available supply. That does not automatically mean default, but it does mean strain. In those moments, exchanges may rely on converting eligible metal into registered or offering cash incentives to settle instead of delivering. But every workaround signals stress, and markets react strongly when stress becomes visible. Now imagine that retail investors continue sending money into SLV at the same pace we saw with the recent $1,750,000,000 in net inflows. Each new share created requires physical silver to be deposited with the trust. Authorized participants cannot print shares out of thin air. They must source metal. If banks and institutions are already accumulating physical silver through delivery, that competition intensifies. So retail buying and institutional accumulation could collide in the same tightening supply pool. Meanwhile, China's export licensing regime, which requires exporters to hold at least 80 tons of annual production capacity, has already limited smaller players from shipping silver out. Position limits on the Shanghai Futures Exchange were cut sharply, and several funds paused new subscriptions. Those moves do not reflect a relaxed market. They reflect strategic control. When a government begins treating a commodity as strategic, it does so to protect domestic supply. China accounts for roughly 17% of global mine production and exports between 4,000 and 5,000 tons per year. If those exports shrink, Western markets lose a meaningful supply channel. And if Chinese authorities ever decide to halt warehouse withdrawals to protect domestic industry, that removes another chunk of accessible metal from global circulation. Even if such a halt never happens, the mere risk changes behavior. Producers hold tighter, traders hedge more aggressively, and buyers become less willing to sell at current prices. Now consider industrial demand again, because it is easy to underestimate how locked in that demand truly is. Solar panels require silver paste to conduct electricity efficiently, and removing silver reduces panel performance. Electric vehicles rely on silver in battery systems and charging networks for conductivity and durability. Advanced electronics, data centers, and defense systems all depend on silver's unique properties. Those industries do not redesign overnight, because silver moves up 10% or even 20%. For demand to truly shrink, price must rise to levels that force engineering redesign over years, not weeks. Mine supply, on the other hand, cannot increase quickly. Discoveries take years to explore, permit, finance, and build into producing mines. Even scrap supply responds slowly because collection systems and incentives take time to scale. So when you combine rigid supply growth with steady industrial demand and tightening inventories, you get imbalance. That imbalance does not resolve quietly forever. Historically, when commodity markets reach this stage, price becomes the adjustment tool. Price rises until enough holders of above-ground stock decide to sell. Price rises until scrap flows increase meaningfully. Price rises until some demand is rationed through cost. Now look at gold relative to silver for another perspective. Gold recently traded near $5,350, while the gold-to-silver ratio hovered around 63-1. Back on January 29th, when silver hit $121.67, the ratio was closer to 45-1. If gold stayed at $5,350 and the ratio returned to 45-1, silver would price near $118. At a 50-1 ratio, silver would sit around $107. At 55-1, it would be near $97, which is close to where it traded just before the recent crash. The crash did not significantly alter gold's price. It altered silver's price by 19% without fixing supply stress. That tells you something about how silver can overshoot in both directions when leverage and emotion take over. Now step back and consider the COMEX stress index reading of 79 out of 88. That is the highest level ever recorded. Yet silver sits nearly 29% below its all-time high. When stress is at record highs and price is well below peak levels, something is misaligned. Either the physical market suddenly loosens and stress drops sharply, or the paper price eventually catches up to physical tension. Markets rarely remain disconnected forever. One side must give. Right now, the data suggests the physical side is not easing. Registered inventory remains far below October 2025 levels. Chinese vault stocks are still at decade lows. Lease rates remain elevated far above historical norms. Swap rates remain deeply negative. Backwardation still runs through the forward curve. Open interest in May remains massive compared to deliverable supply. Retail buying is beginning to return. Institutional accumulation appears steady rather than fading. Every one of those pieces points in the same direction. This does not mean silver must explode tomorrow morning. Paper markets can drift sideways or even lower for short periods, especially if the dollar strengthens or inflation data surprises again. But structural supply-demand pressure does not disappear because of a two-day sell-off. The $78.06 print on March 3rd looks less like a sign of weakness and more like a violent reset caused by forced selling. When forced selling ends, the underlying imbalance remains. Now we are 57 days away from April 30th. That is the next major checkpoint. Between now and then, the percentage of May contracts that choose delivery will tell us how tight the system truly is. If delivery demand stays high, stress increases. If delivery demand falls sharply, that could temporarily ease pressure. But based on the last 4 months of data, there is no clear reason to expect a dramatic normalization. So here on John AG World, we focus on the numbers instead of the noise. We track registered inventory, open interest, lease rates, swap rates, Chinese vault data, ETF flows, and industrial demand trends. Because those numbers form the backbone of the story. And right now, they are all saying the same thing. The paper price and the physical market are more disconnected than ever before. One of them is mispriced. The data strongly suggests which side carries the weight of reality. If you made it this far, type currency archive again in the comments so I know you are part of this serious group that follows the real data. Subscribe to John AG World if you want continued deep breakdowns like this, because we are not stopping here. Share this with anyone who thinks a 19% drop solved the silver problem overnight. This complete breakdown shows that the crash changed price, but it did not change the structure. And when structure does not change, the story is not over.